Well, hi, and welcome to Risk Management. Today we have a guest speaker, Thad Beversdorf of the Institute for Sensible Economics, former investment banker and deep futurist thinker about the world of fractal finance and financial risk and everything that we're talking about in this course. I'd like to introduce Thad and let him give an overview of his presentation on why he thinks we're doomed in the future and how we can get out of it. So Thad, thanks for being with us today in Risk Management.
Thank you, Chris, for having me. Always happy to have the discussion. A bit of an ominous introduction there, but it's not all fantasy, which a lot of people tend to hear the type of arguments that I make and discard them right away, because I think generally the expectation in America is that everything will always be fine. And so let me just kind of explain maybe how you and I met. I had written an article for Zero Hedge. It's an online financial publication, and it kind of goes along with your introduction to myself, where it's known for being all doom and all gloom. The reality is a lot of it is. And in the trading world, generally people find out pretty quickly not to overread Zero Hedge, or you will lose money. And the reality is that you get a very bearish or very negative outlook on markets and the world generally if you're always focused on the doom and gloom. But that doesn't mean that you shouldn't be aware of some of the risks that are permeating across not just the economy, but kind of society as a whole. And so a bit of my background was, as Chris said, I was in banking, international banking for about 15 years. And after that, I had decided, with some help from the bank in the banking industry, that it was time for me to find a new path. And so after I left banking, I went into just doing really a lot of macro research. I understood that there were problems. I saw it firsthand inside the banking world. I knew the types of things that were going on. I was a part of them to some extent. It didn't want to be. And so leaving that kind of environment, it was fresh in my head that I was kind of against what was happening, and that was part of the reason for me leaving. And so it was a natural step into really exploring and spending the next couple of years taking a look at some of the risks that were out there, really some of the absurdities that were going on, and some of the fallacies of logic and the fallacies in the models themselves. Just as a quick anecdote, doing my MBA at the University of Chicago between 2005 and 2008, spent a lot of time becoming an expert in pricing the CDOs and CDSs. I graduated in December of 2008, which you're aware of was probably the highest risk point in the U.S. financial system since the Great Depression. And the reality of what happened was the models that I had spent 3 years becoming an expert in turned out to be wrong. And because they were wrong, it created a tremendous amount of risk in the system. And despite the fact that there were not a lot, but there were several people, prominent analysts and economists, in not just the U.S. but around the world, who had predicted that these models were actually incorrect and that there was a lot more risk in the system than was being priced in. It's difficult for people to understand that the few might be correct and the many might be incorrect. Generally, we believe that if everybody believes something, it must be right. And generally, we accept that until it's proven that it's wrong, and then we move on and accept the next theory or the next model. And so after leaving the banks and stepping into research, what I started realizing really was nailing down in a granular way what was actually wrong, or what is and continues to be today. What are the models, what are the theories, and what are the perspectives that are generally accepted as being correct that actually are not, right? And again, this is in my view, and there's a lot of people who disagree with me and who will argue with me. And what I've tried to do along the way is really, rather than just give my opinion and suggest that, look, things are wrong and this is why, is to always substantiate or validate my arguments with the quantitative data, right? So I try to take the subjective out of it and try to bring the objective into it. Let the data speak for itself. One of the things that we find is that a lot of these issues are very complex, and economists try to make them more complex than they are. And what this does is it really chills out a lot of the kind of brain power that could be being applied to these issues, and that it prevents a lot of people who otherwise could and would understand these issues from even thinking about these issues. When we talk about Brownian motion and Gaussian matrices or fractal finance, a lot of people glaze over pretty quickly, and a lot of people don't want to be in the conversation. But the reality is, none of this stuff is, math is a tool around risk, right? Risk and economics, econometrics, these things are logical relationships, right? So understanding risk really requires understanding how do things interrelate, right? It's kind of, you go back to the old, how the butterfly flaps its wings and it changes the world forever. And risk and economics is really the same idea, in that it's understanding what things in the world affect other things in the world. And the math allows us to establish, or at least within some probability or confidence level, the degree to which those relationships impact each other. And so this is really how I try to go about kind of establishing and substantiating the arguments I make. It's really, I attack the problem from a logical standpoint, and then I try to allow the math and the data to kind of show us the degree of the problem or these relationships. So Chris and I met through, as I said, mentioned, through an article I wrote for Zero Hedge, The Doom and Gloom. And it was generally talking about the fact that, one, it's difficult to make an argument that goes against the grain, because the scholars and the academics generally don't just want to disagree with you, they want to attack you. And to some degree I understand it, because it's you're taking a view that they base their livelihood on, and you're telling them, or trying to explain to people that it's wrong. But more to the meat and potatoes of the article, it's really suggesting that the economic model we live in today is not necessarily what the rest of us believe in, or the majority of us believe it is, right? We generally believe we're in a free market. We generally believe we're in a capitalistic society under an economic model of capitalism. And that's simply not the case, all right? And so the article kind of lays out the difference between what we believe we're in and what we're actually in. And the idea is or the difference, the two different models, one is capitalism and one is corporatism. And this is kind of establishes, or the basis of a lot of the research that I focus on, probably for the past 2 years. And there's a lot that goes into it, but maybe I'll start by we'll look at the first slide here. And really the idea of capitalism. Capitalism is a self-sustaining or a naturally balancing economic model, right? What it means is that there are certain parameters or certain inputs that are required with capitalism. And in capitalism, it's self-contained, meaning that it doesn't need any outside forces in order for itself to in order for the capitalistic model to sustain itself and to continue on as an ongoing model. It naturally optimizes, which means it maximizes its long-term sustainability by optimizing each of the parameters in the short term. And so if we just kind of step back and think about what we know about capitalism, we know it requires investment. These are the risk takers, right? So these are people who have capital, want to put that capital to work. And generally what that requires for them to do that is profit, right? They're not doing it generally for altruism or for the sake of humanity. They're doing it to take their investment and turn it into a larger pool of capital. And so again, in order to get a risk taker to invest into something, it requires profit, right? And so, well, what does profit require? Well, the one thing that all businesses across the world, every business, doesn't matter if it's a goods or services business, the common denominator of every business in the world is one thing, and that's it requires a transaction, right? It means a business has to sell something, whether it be a good or service, to somebody. And who is that somebody? Well, the somebody is a consumer, right? And so the producer, i.e. the enterprise, which is the kind of the foundation or the nexus of investment and profit. So your enterprise requires a consumer, right? And between those two stakeholders, you have a transaction, which we call a sale. And from that sale, you generate revenue, right? And so we've got investment, the risk takers, requiring profit. Profit requires a consumer to consume either a good or a service, right? But how does a consumer consume, right? How does consumption manifest? Well, that transaction requires a form of payment, right? It's a trade-off, right? It's a trading of a form of payment for a good or service. And so consumption requires income, right? And then obviously, where does the income come from? Well, again, it's back to the investors, right? The investors have capital outlay, and some of that goes to fixed capital expenditures, some of it goes to human capital expenditures, some of it goes to technology expenditures, overhead, and what have you. And so this is kind of your capitalism cycle dependency model, meaning investors need profit. Profit needs consumers and consumption. Consumers require income to consume, and income requires some business investment, right, into human capital. And in capitalism, this cycle is self-sustaining in that what it means is all of these parameters in the short term are going to be optimized. And the reason for that is that it's almost to the effect of the weakest link in a chain. If any one of these parameters falters or becomes weak, well, because each of them is dependent on the others, then they all become weaker, right? And so within capitalism, what that means is that in a practical sense, when each of these are making decisions, when risk takers or investors are making decisions as to how to create profit and to how to create consumers and how much goes to income, right? All of these what they're going to do is make sure that they're not hurting one to try to maximize the other. And so let me just give you an easy example. In this, if we can, in this cycle of capitalism, investment, profit, consumption, income, what you often see is today you see CEOs or capital allocators trying to increase profits by way of, let's say, cutting costs, right? So when demand moves down, one of the first things that happens is CEOs will lay people off, right? And the idea that is really you're just reducing your costs, increasing your profit margin, and that's kind of their goal. The problem with this is, and it isn't always a problem, right? On an individual company level, if an individual company's demand function, meaning their customer base, weakens for some reason, right? This is a perfectly viable strategy in the short term, meaning, look, we've got to do what we can to survive. It's better if the firm itself continues as an ongoing concern and makes it through these hard times by sacrificing some of the capital inputs, meaning some factories will close, some fixed capital will be sold, and some human capital will be laid off. The problem is when our economic model goes from, and the point of that is they do that until whatever it is that was affecting their customer base rejuvenates. And then they can bring back those capital aspects, those capital investments, and move on, right? So they get past the hard time by contracting the firm, and then when the demand function problem corrects, now they can become robust again. An example of that would be Chipotle when they had the meat scare just within the past year, a year or two ago. The idea is that was very specific to Chipotle, right? So their demand function was hurt, right? It didn't affect the broader economy, didn't affect other restaurants in their sector. It affected their demand function. So for them, shutting stores, laying people off, selling some assets in the short term, while they could first of all correct the issue, and then while people, over time, people tend to forget about that type of a problem. They put some marketing in place and they promote themselves and they give away some free food and some free meals, and hopefully the demand function corrects itself and now they can open those stores again that they closed down. They can hire more people. So that's kind of the example of capitalism working in a way that doesn't mean you can't contract, right? It doesn't mean that you can't lay people off. Doesn't mean that you can't fire people. Doesn't mean that you can't try to sustain yourself through contraction. Capitalism allows for that, right? But it does it on a proportional basis and kind of for the right reasons, meaning all aspects of the capital cycle will sacrifice. And it's not simply to increase profit. We're not going to cannibalize or contract the firm simply to increase profit. We're doing it so that we can survive while we correct our demand function. So on an individual basis, this is fine. Where the risk really comes into it, where an extraordinary or systemic risk comes into this, is when the individual or microeconomic strategy, which is implemented as a survival mechanism when the demand function reduces or is damaged. When you extrapolate this, or when this becomes a damaged demand function to the broader economy, right? So, and this is kind of real life, this is where we're at, is that we have a damaged demand function in the US and generally in Western developed nations for a variety of different reasons. A lot of bad policy over the years, and also just a function of population growth, right? So today, the Western developed nations have the lowest population growth in history. And this is a problem because although people don't realize it, population growth has been a large factor of economic growth in the US and around the world. And we generally understand that in nations like China or emerging nations, where we understand that there's a massive burgeoning middle class, and that means a massive increase to consumption and demand. And we're in the end of that population growth cycle in the Western nations. And so what we have to understand is that because the demand function is damaged in the US on a macro level, what we have is that we have across the board, we have CEOs implementing survival strategies that we talked about, like Chipotle. So the problem is that when this survival microeconomic strategy is applied on a macro scale, now what you have is the catalyst for the impetus for the implementing the survival strategy, which is a damaged demand function. Now you're implementing this on a broad scale, which means because you're contracting firms across the broad market, right, across the macroeconomy, meaning all firms, and we shouldn't say all firms, but if we look at the S&P 500 or the World Share 5000, what you do find is that almost across the board, probably I would throw a number of 90% of firms have contracted operations over the past 3 to 5 years. And what this means is that what we're doing is we're trying to save the economy, in a sense, by contracting the economy and hoping that it corrects. The problem becomes, when you look at the capital dependency cycle, is that as investment declines and as you try to maintain profitability by reducing capital expenditures, by reducing human capital expenditures, i.e. labor costs, it's those labor costs. So if you look at this cycle in reverse, as you shrink income, you shrink consumption. As you shrink consumption, you shrink profit. As you shrink profit, you shrink investment. And as you shrink investment, you shrink income. And the idea here is that you effectively put yourself into a demand death spiral, right? So on a macro scale, when you implement a survival strategy, you actually destroy the very reason for implementing that strategy, i.e. the demand function. You're actually hurting that demand function even further. And so this is the basis of the article, or this was the basis of the discussion. And this is a significant problem. I mean, this is something that we generally don't think too much about, but it is the basis of 4 decades of stagnation. And it is what we find over the past, since 2000 and really since 2008, is this kind of what I call a death spiral of demand, is the downward spiral is accelerating, right? Meaning the deceleration in growth is getting faster and faster and faster. And we're to the point now where growth is almost at zero across a number of metrics. Whether it be earnings, revenues, GDP, incomes, we've gotten to a point where the contraction is not just slowing growth, but it's actually turning into contraction on a broad scale. And so I developed a couple charts here just to show us how capitalism actually works in the economy and some metrics around it. So if we look at the second slide here, it's kind of a representation of capitalism. And again, what we have are investors. Investors invest into what's called a domestic business investment. So what does that mean? It means fixed capital, it means technology, it means labor. From that, you get production, meaning production of goods or services. And then you need your consumption. And you'll see that labor is necessary for consumption. Now, what this chart shows is you'll see that there's an arrow going from labor to consumption. And historically, what we find is that consumption was made up of 80% income and 20% credit and welfare, right? So it's never been 100% income in reality. That is how we consume, right? So we've always had some credit and we've always had some welfare. But through history, up until about 1980-ish, did that start to really decline, okay? And so we've got jobs, income, and a little bit of credit and welfare is from how we consume. From that, we get our profits. Then profits get, as we said in the capital cycle, profits get reinvested back into a couple different things, right? So CEOs will allocate capital either to capital expenditures or new business investments or expanding existing business investments. And they distribute some cash, right? So shareholders require a return as well, right? They're not there for the good of humanity either. They want investors and shareholders also want to get generate a return. And so historically what we find is that this ratio has generally been about 3 to 1, meaning that Business investment has been about 3 times what the cash distributions have been, right? And so from this business investment, we've got this arrow coming across the top that comes back, and that those profits go into business investment, which begins the cycle again of fixed capital, technology, and labor. And that's kind of our capitalism cycle. And what we find is that this business investment, right? So this kind of, you take your profits, you split it between cash distribution and business investment. And what we find is that business investment as a percentage of GDP throughout history, I mean, this goes back over 100 years, has always been pretty steady. I mean, around 7% of GDP, okay? And these cash distributions, going back the same duration over 100 years, has generally been around 2% of GDP, okay? So this is what this is generally generated over time, is an economy that grows just under 4% per year. Okay, so here's capitalism. This is here's the model that we believe we live in, right? And the next chart I'm going to show you is a model of corporatism. Okay, what you'll find is that it's very similar, and this is why it's very difficult for people to, it's not like you're going from capitalism to pure socialism or to communism, where it would be a very overt change, and people would be very aware of the differences. You can see by looking at the last chart and this chart, they're almost identical. They're almost identical. And so unless you're someone who really understands this stuff and really digs into it or has interest in this, it would be very easy for you to step back and say, look, it all looks the same to me, right? We've got investors, we've got business investment, we've got productions of goods and services, we've got consumption, we've got profits, and we recycle those between business investment and cash distributions. What's the difference? Well, the differences are perhaps minute in observation, but are extremely potent. And so what we find is in corporatism is that our percentage of consumption, so the means that we consume by, is now down to around 60% income and 40% credit and welfare. Okay? And if you remember, under capitalism, we were 80% income and about 20% credit and welfare. Now, again, this didn't happen overnight. It trended down to these levels. And this is kind of where we're at today. If you look at the distribution or the capital allocation between, so we take our profits and our CEOs allocate that capital between business reinvestment and cash distributions. Today, what we have is cash distributions are about 3 times the amount of allocation that's going toward business investment. And again, if you look at the arrows, so what percent of GDP is the business investment? Well, today it's about 2% of GDP, whereas the cash distribution is about 7% of GDP. Okay, and what this means is, you can see, is in a model of corporatism, what we've effectively done is we've reversed the capital allocations, meaning what we're using capital toward, business investment being a productive or an economic investment, meaning that it actually generates a money multiplier effect, right? I build a factory, I generate output, I hire people, I pay them wages, they consume, other people consume. This is an economic activity. Cash distributions, generally, now Wall Street Journal did a study on where do the cash distributions end up, right? There's some speculation, well, that goes to the money multiplier effect as well. But the study that they did, and this is commonsensical to some degree, just given marginal propensity to consume, right? Is that the cash distributions, 85% of those are reinvested into basically financial markets, right? And so there is very little economic effect happening from cash distributions, meaning it's not being put toward business investment, and it's not generally being spent in the economy either through consumption. These cash distributions are generally just being reinvested into a secondary financial market, which never hits a corporate balance sheet, and which generally is never used to consume. Now, I don't know if you could see this, but dividends 70% of dividends go to the top 12% of Americans, of American workers, right? And so what you have is, this is kind of the reason that you have very little money multiplier effect from these cash distributions, is that such a large percent of these distributions are going to such a small percent of the population. And then even that, generally those people aren't spending that cash. And that 12% of earners are bucketed in 100 people who earn 100,000 or more. The vast majority of that is at much higher levels. And so what you see is the impact of the result of this corporatism is in domestic economy, the average growth is about half what it is under capitalism. And the problem is that that's continuing to decline. So what we find is that this model of corporatism, where capital and resources are being misallocated or misused. Now, that's a bit of a subjective statement, but what it suggests is that when capital or resources are being used towards things that do not create a money multiplier effect in the economy, which in effect don't create more activity, but become, in effect, only a matter of financial investments and financial returns. The economy, it continues to decline. So it doesn't get to this 2% level and then it stays there. So since 2000, the average growth is 2% annually. But this is continuing to decline. And today we're actually slightly less than 2%. So this is the basis of kind of a lot of the research that I've done. And what you have to derive from this is just not interesting conversation or interesting kind of analytics or research. The idea behind this is that without recognizing the difference between capitalism and corporatism, and the titles are not important, right? So the names, whatever we're calling this capitalism, we're calling this corporatism. It's not meant to be attacking, kind of a particular economic model. It's the fundamental implications of misallocating resources creates a tremendous amount of risk. And what I would suggest is a fatal amount of risk, right? The idea being that we are moving into economic territory that at a certain point you simply can't get out of. It's like the event horizon in a black hole. Once you cross that line, it doesn't matter what you do. And we're getting very close to that. Let me give you an example of why I say that. So since 2000, we've implemented the most extreme monetary policy in the history of the universe, right? So what we've done is we've printed $13 trillion, right? So we printed twice the amount of money that we printed since the beginning of the US, right? And we've done that in the past 8 years. And we did this because monetary theory or economic theory tells us that if we infuse a bunch of money into the economy, we should create a boost to the economy. And when one understands how that works, it doesn't mean, look, the Fed's going to throw a bunch of money into the economy and that will fix everything. The idea still comes back to monetary policy and fiscal policy are still only indirectly responsible for moving the economy, meaning that when the Fed prints money, when it lowers interest rates, what it's doing is it's trying to incentivize CEOs or capital allocators to use money in a way that's productive, meaning in a capitalistic way, right? It wants the capital allocators to in effect invest in productivity, invest in production, right? Get the money multiplier cycle going, generate economic activity. The problem is that, and this is clear since 2008, is that despite having printed $13 trillion, we failed to achieve any economic growth. We're still, we're back down to almost 1.5 or 1.7, whatever it is these days, on an annualized basis. So we're under 2% economic growth, right? And so how could that be? If we printed the most money in the history of the U.S. over the past 8 years. In fact, doubled the previously existing money stock. We've had interest rates at zero. And remember, what do zero interest rates mean? Well, all that means for a capital allocator is that you're increasing my return on investment, right? Because you're reducing my cost structure, right? And by reducing my cost structure, you're fattening my profit margins. Fattening my profit margin means I have a greater return on investment, right? So that should be a good thing. And when I have a greater return on investment, I should invest, right? And so that's the theory of monetary policy, right? That's how it works. But when we actually look at the data, what we find is it didn't work, right? It didn't work. And so if we look at the next chart here, so what we have here is we have domestic business investment. And this is, I think this is real. So I've just divided this by the GDP price deflator, right? And so what you'll see here is that while domestic investment increased from where it was at the very collapse of the first quarter of 2009 or somewhere in 2009 here, you can see the bottom, we actually have increased quite a bit, right? And again, these are in dollar terms. But if you look relative to where we were in the late 1990s, even in the mid 2000s and today, well, you see that in real terms, productive investments in the U.S. are actually quite low relative to where we've seen them previously. Right? We're back to 1980 levels, in effect. Now, when you put this in perspective in terms of money supply, this is an extraordinarily low amount of investment here in the U.S., given the amount of money that has been generated and printed to incentivize this very thing, to incentivize productive private domestic investment, right? And so if we look at this in terms of, in terms of a percent of GDP, so this is what I was talking about before in the capital and corporate cycle, this is the amount of profits that's going to private. So the capital allocation or capital that's being allocated back to domestic investment, private business investment here in the U.S. as a percent of GDP, right? And so what you'll see is that back in before 1980, you had a pretty steady ebbs and flows of peaked out at around 7%, or the low end was around 5%, and obviously the average then was somewhere in between these ranges. What you find is that after 1980, we had a pretty significant decline for a duration of period. You can see that these waves prior to 1980 are pretty short. Subsequent to 1980, the waves get quite a bit longer. And what you'll also find is that there's kind of this random walk down to where we are today, which is, other than the great financial collapse of 2008, we're about at the lowest point we've been over the past 50 or 60 years. And that actually goes back all the way to the Great Depression. Okay. And so what we find is the point of this is that while we have the most extreme monetary policy being implemented for, let's say, the past 8 years, right, which is longer than a normal economic cycle, we haven't gotten the objective, right? The objective is increasing private domestic investment, and we simply haven't gotten that. And this is a scary proposition, right? So this is a scary proposition. This is risk, right? This trail off here, right? So this downward trend with lower lows and lower highs, what this suggests is that we're spiraling toward zero. We have to understand is what happens when we get to zero. Right? What happens when we get to zero? And it's something that I don't know the answer to, and I don't know that anybody knows the answer to. But what I can suggest, commonsensically, is that it becomes a problem you might not get out of without having a significant reset, right? Meaning that the entire system has to be restructured at that point, right? So what I want to do is continue on with some of these charts. Let's see here. I just want to drill home the problem. So here's gross 10-year moving average, gross fixed capital formation growth rate. What you can see is that we're somewhere between 0 and 1% now. And again, this is just kind of drilling home the point that what we're lacking in the economy is productive investment. And again, this goes back to the idea of the capital cycle, right? Which is that if you don't have this private investment, then where is the money going? Because we still have record profits happening, right? So there's still record profits in nominal terms. And again, the idea is that the capital is being misused. I want to show you a chart that kind of blew me away when I ran this data. I had a theory that I was going to see something to this effect, but I didn't think it would be quite this kind of black and white. So what we're looking at here is we're looking at net dividends as a percentage of GDP, and we're looking at net private domestic investment as a percentage of GDP. So similar to the charts we just showed with the private domestic investment as a percentage of GDP. But this runs back to, now these are 7-year moving averages, so a normal economic cycle. So the raw data goes back right up to leading up into the Great Depression in 1929. And what you'll find is that the only 2 times in history that we've misallocated capital to the extent that we are today is today and the period leading into and during the Great Depression. Right? You can see how steady private domestic investment is as a percentage of GDP, the blue line. You can see how steady dividends as a percentage of GDP has been, the red line, other than during the Great Depression and today. And the point here is that this isn't a coincidence. This is a consequence. Right? This isn't a coincidence. This is a consequence. This is what happens when you misallocate capital. Now you ask, why are we misallocating capital? And this is a great question. Now, part of the reason is that when you look at some of these, some of the data points, what you're going to find is that there's a couple key points in American history that you have major inflection points. So one was in 1971 when we absolved the quasi-gold standard that we were on. We went to a pure fiat monetary policy or currency. The second was the Tokyo round of GATT, which was a large trade agreement, free trade agreement that started back in the 40s. There were several rounds, but the Tokyo round in 1979 was the largest round. In fact, it was 5 times the amount of benefits to corporations that any of the other rounds were. That's really not important. The point is that what happened subsequent to GATT was that you began to have massive movements of production overseas, right? And effectively what this did was what this trade agreement did was it allowed corporations to take advantage of cheaper labor cost structures in foreign nations while preventing tariffs being applied to the products that were being produced overseas that were then being sold back into the US, right? And then if you look at in 1993 with NAFTA, you'll find the exact same thing happen, but to a large greater extent, which is that production was moved overseas and those products were still being sold back into the US. Now, what's the problem with that? Well, the problem with that is that you've got an imbalance then between production and consumption, right? You've got an imbalance between production and consumption. And if we go back to the investment cycle, what does that really mean? Well, it means that what we're doing is that we're maximizing profit by minimizing income. And what we said about capitalism was that can't happen. You can't increase profit by decreasing one of the other variables. But that's exactly what the trade agreements allow us to do. It allows us to minimize our income, our labor costs, and what that does is fatten our profit margin, right? The problem then is, what happens to consumption? If we reduce income, we reduce consumption. If we reduce consumption, we should be reducing profit. And if we do reduce profit, we reduce investment. So how is it that we can reduce domestic income but maintain domestic consumption, right? So how do we reduce income levels here in the US but increase consumption levels? Because remember, the investors who are lobbying for these free trade agreements, they are trying to maximize or increase profits, right? So in order to do that by decreasing income, you still need to increase consumption somehow. And the how there is exactly what we saw in this model of corporatism, which is right here, meaning that as labor is sacrificed to reduce the cost structure to increase profits, we went from what was 80% of consumption coming by way of income to only 60% of consumption coming by way of income. And what increased? Credit and welfare, right? So in effect, what's happening with these trade agreements, GATT and NAFTA, by shipping production overseas, but still relying on the American consumer to consume, to generate profits for those firms that are shipping the production overseas, is yes, they're reducing their cost structure and thereby increasing their profit margins, right? And their total nominal profits. But that's being subsidized. It has to be, right? It has to be logically, as we saw in the first slide, and it is by way of what we see in the data, right? So their profit has gone up, but the only way that they've been able to increase profit is but through sacrificing income, is by having the government subsidize through guaranteed credit and sometimes not guaranteed credit, printing money and allowing financial institutions to in effect provide more credit to the economy, and welfare, which is a direct subsidy from the government, right, from the taxpayer. And so this kind of explains the problem with corporatism, is that corporatism is really a model, whereas capitalism is a model that is self-reliant, self-sustaining, balances each of the stakeholders in society. Corporatism is really, it's a model of subsidizing corporate profitability. And the problem with that is, there's beyond the obvious problem, which is a matter of ethics and values and fairness, picking winners and picking losers, is that you're subsidizing these profits, and these profits aren't being pushed out to the corporate balance sheets and thus going back into the economy. They're simply on the balance sheet and off the balance sheet, right? So these profits that are being subsidized through credit and welfare are just going directly into cash distributions and making the top 12% that much wealthier. While the balance sheet of individuals and the financial wherewithal of individuals, meaning your 85% of Americans, is worsening. And so The argument to this that you'll always hear, that these trade agreements are good. And let me just explain why the free trade agreement, I don't like calling them free trade agreements. They're not free trade agreements. And this is, there's a big aspect of risk here, right? That these trade agreements are targeting. The idea is that a free trade agreement has basically two basic objectives. One is labor cost arbitrage that we touched on, we talked about. So the labor cost arbitrage, what does that mean? Well, it means I can get the same amount of labor at a cheaper price, right? I have two things. One cost me $100, one cost me $10. They're the exact same thing. I'll take the one for $10. And so the free trade agreements, what they call the free trade agreements, the number one objective is that labor cost arbitrage, right? It's trying to create a way for corporations to increase profits by way of reducing their labor cost structure. Now, that itself wouldn't be a terrible thing. But what makes this, what turns this into a subsidization is that those corporations still want to sell that production that's being done overseas back into US consumers. And again, on a macro scale, what that requires is it necessarily requires an increase of credit and welfare, meaning that those trade agreements, by generating that labor cost arbitrage, which creates an imbalance between production and consumption, well, if you're reducing the domestic income by shipping production overseas, but you still want that consumption to increase, well, then you need an exogenous factor. You need something, you need a subsidy, right? You need a subsidy. And so that's the real problem with these trade agreements, is that they necessarily rely on the subsidy of credit and welfare to be effective. And that's kind of, when you look at the historical data, you actually see that there's massive inflection points right after 1979, which was the GATT round, or the Tokyo round of GATT, and in 1993, the NAFTA. Now the argument is that, well, it's just a changing economy, right? And so yes, we're getting rid of some manufacturing jobs, but what we're creating is a new high technology workforce and economy. And so while we're losing manufacturing jobs, we're gaining a lot of other breadwinner jobs, meaning that there's a whole other industries that are popping up. And so, it's not a terrible thing that we're losing one and gaining the other. But if we actually look at what we've gained, so we look at the actual numbers of breadwinner jobs in the U.S., okay? So what we find here is, here are U.S. breadwinner jobs as a percentage of working age population, right? So what this means is that if you take the amount of jobs divided by the amount of people who are looking for jobs, or the age population who are working age people, this is what you find, okay? So what you find is that we've lost about 5% of me. So think of it this way. Your probability of getting a breadwinner job today is 5% less than it was in 1999, right? As a working age, if you're in the working age population, you actually have a 5% less chance of getting a good breadwinner job, meaning a job you could raise a family on, right? You have a 5% less chance of getting a breadwinner job today than you could in 1999, right? And this is a significant problem. And let me show you where this comes in, because again, this is a ratio, right? So this can increase or decrease by changing the numerator or the denominator. So let's take a look at the denominator and the numerator. So here's the amount of jobs. So here's the numerator. What you find is that even in the nominal amount of breadwinner jobs, there are fewer. In fact, there are 1.5 million fewer breadwinner jobs in nominal terms, not just the ratio, right? In nominal terms, there's 1.5 million fewer breadwinner jobs in America today than there was in 1999, right? And so our ratio So your probability of getting a job isn't just that the population increased, it's that there are actually fewer breadwinner jobs today than there were in 1999. And this is a result of the trade agreements, meaning that investment isn't coming back to the US in these technology fields. Now, to some degree it is, and there's a technology issue in and of itself, in that you look at a firm like Facebook, where it's a digital company. What happens in that? There's a lot of money that's invested into that. But whereas GM, during its prime years, had 900,000 employees, right? Had 900,000 employees who were generating breadwinner incomes. Facebook, which is worth significantly more than GM ever was in terms of market cap, has 12,000. So you have this extraordinary amount of investment capital being put into a firm that is only paying 12,000 people. Now, this isn't because Facebook is evil and they don't want to pay people, right? This is simply contextual. This is a matter of a digital world. And not only is there a money multiplier problem between the old world and this new world, in that there's a far fewer amount of people that are needed to run these firms. And so there's far less people who are consuming based off of that income from these firms. But if you think about upstream as well, you think about a manufacturing firm like GM, and you think about all of its physical suppliers and all of the incomes that those firms are paying. So GM had 900,000 employees, but it also had a tremendous amount of upstream vendors and suppliers who were also paying. When you look at Facebook, Facebook is a digital world. And so it has far fewer employees, but it also has far fewer upstream vendors and suppliers, right? It doesn't have to buy axles. It doesn't have to buy calipers and brake pads, right? It generates it by these 12,000 people who generate their digital world right there in the office. It really doesn't have a lot of vendors and suppliers now. They'll have outsourced programmers and this kind of stuff. But again, you can see the difference between the old world and the new world just simply in terms of the money multiplier effect, right? And so there are other aspects that it's not just CEOs who are evil people who are trying to create all these profits. We've got to get away from that. There is some of that, and there is some of the greed that's into it. But a lot of this is simply people doing what they need to do to survive, and to some degree, changes in the economic landscape, meaning technology in a digital world. And here's just your denominator again. Working population has gone up. So again, this just goes back into saying that your probability of getting a breadwinner job in the U.S. has declined by 5%. Now, 5% may not seem like a large number, but again, when there's 205 million working age people and 5% fewer of those are going to get a breadwinner job, you're talking about 10 million proportionately fewer people today who will have a decent job than in 1999. And that goes to the point of this damaged demand function, right? So this is where this damaged demand function comes in. A breadwinner job allows people to have some savings, pay their bills, have some discretionary spending. When you don't have a breadwinner job, when you're struggling with no jobs or 2 jobs or 3 jobs, and you're making minimum wage, and your healthcare coverage is not very good, and you don't have a lot of benefits, you don't have any discretionary spending, your disposable income is very poor. And this all goes back into the idea that when your consumer, i.e. who is also your laborer, has been hurt, and a large reason for that are these trade agreements that have allowed, across a macro scale, have allowed corporations to increase profits by labor cost arbitraging production. That all comes back to haunt you. Again, it requires ever increasing amounts of credit and welfare. Well, remember, credit and welfare are still a function of income, meaning you've got to reasonably be able to pay off the amount of credit that you have by way of income. And if income hasn't increased in 40 years in real terms, but credit has increased by 300 to 400% in real terms, you're at some point going to reach peak credit, meaning that at a certain point you can no longer increase the credit that you've taken because your income simply hasn't changed in 40 years. And so on a macro scale, what you find is that we're entering peak credit, we're entering a flattening population growth, and incomes have been stagnant for decades. And so if incomes are stagnant, credit is now flatlined, and population has now flatlined, where does growth come from? And this directly impacts the markets, right? This directly impacts the markets. And the idea being, we're at all-time highs, generally all-time highs in the US market. It's absolutely not a function of fundamentals, right? It can't be. We're entering the fifth quarter of earnings declines. Revenues have been declining for 3 years. And revenues is top line, that's operations. So operations have been contracting for 3 years. Earnings, not that long, because even while operations were contracting for the first year or two, we were still able to increase earnings by contracting the operations, right? So by closing factories, selling assets, laying people off, that's how we were achieving earnings growth. But at a certain point, all the fat has been cut. There's nowhere else you can trim the cost structure. And by way of doing those things, you've actually further destroyed the demand function. We've implemented the most extreme monetary policy in history to try to correct the situation, and it hasn't worked. There are some strong arguments for fiscal intervention. The problem with fiscal intervention at this point, meaning fiscal policy, cutting corporate taxes, all of these things still are trying to incentivize capital allocators to expand operations in the face of a damaged demand function. If you have too much capacity already as a CEO, and either the Fed or Congress is asking you, in fact, telling you, I'll give you free money if you invest it. As a CEO, I would love to do that. I already have too much unutilized capacity as it is. I can't take that money and build a factory I'm not going to use, right? And so the only thing I can do with it is I'll take that free money, right? I'll take that free money, but I'm just going to dish it out. And that's exactly what we've been doing, right? So that's exactly what's been happening with our monetary, fiscal, and economic policy. Let me just show you real quick why all economic policy frameworks are directed at creating domestic private investment. So here what we see is year-on-year change in private domestic investment and salaries and wages, okay? And so the idea here is showing the relationship between private domestic investment and domestic income. Now, I've done this on a per capita basis, so you can actually see the impact it has on an individual worker here in the U.S. Okay, and here I've just real quick, when you run a regression, so when you run domestic investment onto incomes, what you'll find is that you don't just have a very strong correlation coefficient here being 0.76, meaning that for every dollar of domestic investment here in the U.S., every additional dollar of domestic investment, you create 76 cents of domestic income. Now, this is massive. And this isn't just a correlation. The regression statistics behind this are highly, highly statistically significant, meaning that, and you can generally just eyeball this when you look at the chart. The idea being that there is a very direct relationship and causation from between domestic investment, private domestic investment, meaning business investment, and incomes here in the U.S. The more business investment you have, the more incomes you're going to have, the higher incomes you're going to have. And this is why or economic policy frameworks, both fiscal and monetary, are their objective is to incentivize CEOs or capital allocators toward private domestic investment. When you don't get it, you fall into the problems that we have, where your demand function becomes damaged. The reality is it becomes a chicken and the egg kind of problem, right? As a CEO, I don't want to invest. I don't want to expand my operations. I don't want to invest in my operations because there's no demand to consume it. But as I contract my firm and as I don't invest in productive investments here in the U.S., the demand function worsens because I'm destroying income on a macro scale. And so you get this, well, if demand was better, I would invest, right? And if I would invest, demand would be better. But so it's this chicken and the egg type problem. And so there's got to be a solution to this, right? There's got to be a solution to this. And the solution is, who knows, to be honest, what the solution is. But if there was a way to concentrate demand, right? If there was a way to concentrate demand on a macro scale toward firms that are rewarding private domestic investment, meaning today what you have is firms are more than willing to take cheap capital from the Fed. They're willing to take their revenues, but what they're doing is they're throwing that out, they're pushing that out the door to cash distributions, right? They're not pushing that toward economic activity, productive activity. If you could concentrate consumer demand toward firms that actually were using or would be using that capital toward productive investments, you would have a self-fulfilling or self-correcting kind of model rather than this death spiral that we're in, meaning the more cash I pull off a balance sheet and throw out the door to shareholders, the worse the income level gets, the worse the demand gets, the worse the demand gets, the more cash I'm going to throw out the door and the less I'm going to put toward productive investment, right? So that's your kind of self-fulfilling downward death spiral. If you could do it the opposite way and you could concentrate demand and push those revenues and capital toward firms that actually will invest toward productive activity, economic activity, well, think about what that does. That's the reverse. As domestic activity goes up, with this chart shows, income improves. As income improves, the demand function improves. As the demand function improves, more firms can allocate capital toward productive business investment, and the cycle repeats itself. Business investment improves income, improves the demand function, more money can go toward business investment. So the idea here is that if there was a way to concentrate demand toward firms that actually efficiently allocate capital and resources, the problem becomes self-correcting rather than an accelerating downward death spiral. And how you do that, this brings us kind of to a project that I'm working on today. Again, I think Chris mentioned I was from the Institute of Sensible Economics, which is just a nonprofit foundation or institute that I've created. I've brought some good people around. Chris has been an advisor on this as well. And the idea is to find a way to harness the power of aggregate consumption in a way that allows consumers to direct or concentrate their own consumer choices, their demand, toward these firms that actually do allocate capital efficiently. Right? And so the model itself is very similar to something that everybody's seen out there, which is the organic model. a certified organic model. The idea being that you had a consumer base that didn't realize there was a problem. And so it required initially educating the consumer that there was a problem. And then you had on the production side or the producer side, you had firms that didn't want anything to do with organics. And so what it required was both educating a consumer that there was a problem and then trying to change their consumer behavior in a large enough way that it would force corporations to go against their own will and produce organic foods. And in the end, it actually worked. Right. In the end, it actually worked. Whereas in 1997, about 0% of total food market share was organic. By 2003, about 1.5% was. And it was around 1.5% to 2% market share of organics, where corporations, against their will really, started to distribute organic food, right? Meaning the Del Montes of the world, the Doles of the world, so actual food producers who didn't want anything to do with organics actually established organic divisions. Stores, distributors like Walmart and whatever the food chains around you are, started creating organic sections, right? So what this means is that consumers, right, what this shows is that actually consumers do, when consumers can concentrate their demand, right? When consumers decide to harness the power of aggregate consumption, even to a very small extent relatively to the total market share, meaning 1% to 2%, right? So when you can harness 1% to 2% of market share and direct that toward a particular ideology or particular consumer choices, corporations will actually change the behavior. And what we're doing at the Institute for Sensible Economics is really trying to undo the downward spiral that the reality is there's no way to get out of this, because Fed policy is trapped, fiscal policy is trapped. Without a demand function improving, CEOs, capital allocators simply will not move toward domestic business investment. It's just not going to happen, and it's not because they're bad people. They simply have a fiduciary responsibility not to throw money away, and so they won't, and they don't, and they haven't. And so the idea here with the Institute of Sensible Economics is to find a way, similar to where organic found a way to harness aggregate consumption, and not 100% of aggregate consumption, but enough aggregate consumption to force corporations to change their behavior. We're developing a model whereby consumers can kind of harness and consolidate or coordinate their aggregate consumption toward firms that allocate capital efficiently. The idea being, again, based on everything that we've discussed here today, is that private domestic business investment becomes a self-correcting solution, meaning that the business investment improves incomes improves demand allows CEOs, and remember, it allows a CEO to allocate capital toward operational expansion, in effect. And without that demand, they simply cannot do it. And so it really becomes a matter of, it is a chicken and the egg. You're not going to convince the CEO to do it. So in some way, you've got to find a way to have the demand side incentivize the CEO. And really, it's not incentivizing, but allowing the CEO to invest in productive activity. So that's kind of, in a nutshell, that's the world, guys. This is there's a lot of risk that's not being priced into things. The broader economy, if you get outside the cities, what you'll find is that people really are hurting, and it's, you see it manifest through whatever your political affiliation. You see it manifest through Bernie Sanders, through Donald Trump. These are the consequence or the implications of people who have for decades now not progressed, right, not prospered at all in society, at least economically. Look, we're the millennials, they get a hard time, I know, but the reality is they will be the first generational decline in American history. And so if you can put yourself into their shoes for a minute, and maybe some of you are millennials, it is a very tough future for the vast majority of them. Right, there will be a lot of successful millennials, but the landscape has changed dramatically and drastically to where they will be the first generation that's worse off than the previous generation, and that's just the tip of the iceberg. So you take Generation Z, who's following up behind them, kids who are between the age of 9 and 20 right now, and this generational decline will be a perpetual generational decline unless we break this kind of corporatism death spiral that we find ourselves in today. That's it.
Great, Thad. Thank you for this. A couple of follow-up questions for our students. One would be, how do students get involved with something like this? How can they make a difference given the information you've put out today, what the Institute for Sensible Economics is doing? Students interested in this topic, how should they become further involved?
Yeah, it's important, and the first thing I think people need to do is understand the problem. Right, they've got to understand that the power to correct the problem they already have. Right? It's at their fingertips. They've just got to understand how to apply that power. And so what we're planning on doing is we really haven't launched the Institute publicly. The solution will be done through a platform called Certified Sensible, which would be a labeling similar to Certified Organic, which will allow consumers to align their consumer choices with what we'll say are efficient corporate strategies or better corporate behavior. And so there is a website, certifiedsensible.org, that they can go to. We expect to launch publicly, which means we'll have various campaigns, marketing campaigns, and also affirmation campaigns. We really want feedback from consumers. The reality is this is being done by the circle of people who are involved in this, really for all the right reasons. None of us are going to get rich off this, and none of us are looking to. In fact, if and when this becomes successful, I will, in all likelihood, walk away from it and let those who are better apt at running something like this take charge and push us forward. And so people who want to get involved, you can reach out to me directly. We're really trying to organize right now a grassroots kind of a campaign and push across various grassroots communities, including the collegiate. So reach out to me directly. Go to the website certifiedsensible.org, and let us know that you're interested. Give us some feedback. And again, look for it in probably mid-November for the campaign to launch kind of officially.
Great. One other question that might come to mind for some of our students would be, you had mentioned the financialization of Wall Street as a result of these incentives that have been put into place for them. What do you envision happening for firms that are currently financializing and acting in a corporatism model? How will they reform themselves like organic foods in the future when and assuming that this model that you're advancing through Certified Sensible comes to work?
Right. So the idea is that, look, this is, whereas organics is really, they've created a ball of concentrated demand, and that has drawn other producers toward that concentrated demand. The idea being that businesses like demand, they need demand. And so if there's a concentration of demand somewhere, it's going to draw corporations toward that. Where organic is really a category sector. what we're creating is a concentrated demand around a strategy sector, meaning that if you want to partake in this concentrated demand that's being created through this Certified Sensible platform, in order to get hold of this demand, or in order to participate in this concentrated demand, what you've got to do is change your corporate strategy. And so the idea is to create this ball of demand concentration that feeds off of a certain strategy. And so if corporations are naturally being drawn toward that concentrated demand, the idea is that even to a small degree, they're going to have to start changing their capital allocation or their resource allocation strategies to something that's much more effective and efficient. And as what happens is that this becomes or an exponentially correcting problem. So the idea is that it took 10 years in organic to go from 0 to 1.5% market share. In the next 10 years, it went from 1.5% to 7% market share. And so there's an exponential growth, and that's not a coincidence. It's the fact that as corporations start changing their behavior, the problem does actually become self-correcting in that exposure is greater. So you have more companies doing this. You have more choice for the consumers. And also in our model, it really becomes fundamentally or intrinsically self-correcting in that as these firms start changing their behavior toward efficient resource allocation, they're actually beginning to improve the demand function. And that improved demand function exponentially allows more business investment, and it cycles back. So it's really creating that demand, concentrated demand around a certain strategy. And that strategy, in order to get at that concentrated demand, you've got to become, at least to some degree, part of that strategy. And as we bring firms around those strategies, the problem becomes very exponentially self-correcting.
You mentioned earlier the so-called free trade agreements with partners overseas, like the Tokyo Round, or in our most recent version of this, the Trans-Pacific Pact. Do you anticipate that those pacts will have to be renegotiated? How will the so-called trading partners deal with this in light of what you're proposing?
Right, and honestly, this is kind of the basis of the model, which was thought about pretty extensively for over a long period of time. The idea is that you're generally not going to get legislators to change to change these trade agreements, because there's the corporations or the lobbyists, the special interests really want them. And so it becomes a very difficult thing to legislatively change the policy. So the idea behind Certified Sensible, and really what you're doing through this is you're creating a fourth economic policy framework. Right? Today we've got monetary policy, fiscal policy that are both trying to incentivize microeconomic policy. And the idea here is that you have the actors of these policies being bankers, legislators, and CEOs. Well, none of these are the target or the objective of the policies themselves, which is to improve middle-class America, right? Which has always been kind of the engine of American prosperity, right? So you're trying to improve the economic or financial wherewithal of 85% of Americans. And you're doing it by allowing bankers, legislators, and CEOs to dictate policy. And so the idea here is to is to bring a seat at the table for the actors of the policy themselves, right? You're aligning the actors of the policy with the objectives of the policy as well. And so in that sense, you're creating this kind of fourth economic policy framework.
That's great. Well, we're just about out of time here, Thad. Is there anything else you'd like to mention, or something that in your wonderful lecture you haven't brought forward for our student population here?
Look, really what I want to get across here is really just the fundamentals in the discussion itself, which is the idea that, look, it doesn't matter if you're a trader, a banker, an economist, a librarian, right? This is what we discussed today has significant implications to both your professional and your personal life. I would say, think about the things that we discussed. Understand the significant amount of risk that is in the system. And we're talking systemic risk, the epitome of systemic risk in the system, in that we're really in a downward spiral that almost by definition we cannot get out of at this point. And so whether it's whether you become interested in our platform, our certified sensible platform, what I would suggest is become involved somehow. Understand the problem, really understand the problem. Understand that it's not just going to have implications to your own life; it's going to have implications to every follow-on generation. This is really kind of one of the greatest moments in American history, or at least the pivotal moments in American history. We are at that point of no return. Some say we're beyond it. Some say we're just in front of it. But we are at that point of no return. And look, these your students are obviously interested in this stuff. And it will have the understanding that most people don't have. Use your skill set, use your conscience, understand the problem, and find ways to make a difference.
Thad Beversdorf from the Institute for Sensible Economics. Thanks for joining us in Texas A&M's risk management class.
Thanks so much, Chris. I appreciate you having me. I can that.
Yeah, you just hit the end record somewhere here. You should have a record button.
Yeah, it didn't come up again. I think. Did you do something to get me that?
No, let me see. It's going to be on your side, Thad. I've got.
I got it. That popped up.
Okay.